Stocks closed down on Friday with delivery of a key report on the labor market's recovery. The report showed a much weaker than expected pace of hiring last month, and so the S&P 500 cycled between gains and losses through the day after 3 consecutive days of advances. However, the index still advanced for a weekly gain. The advance came after Senate leaders reached an agreement on raising the government borrowing limit into early December. This helped dodge a default, but just kicked the can down the road. How typically political. With the debt ceiling pushed off, investors fixated on the monthly jobs report. The report showed another miss on payroll gains. But on one hand, the unemployment rate fell, more than expected, to 4.8%. However, on the other hand, the labor force participation rate, which in my opinion is significantly more important, fell to 61.6%. The reason the participation rate is more important is because, as we can see, the fall in unemployment is a mirage, while the participation rate is not as easily manipulated with fancy footwork by the government. And yet, there was enough information to believe the Fed tapering is still on schedule. Also on schedule is inflation, so keep a close eye on those earnings report. For now, we'll keep an eye on the charts. And we're now looking at the 6-month daily chart on the spiders, the SPY, and the close on Friday was 437.86. So from this top in early September, we had the downdraft, but we definitely see some nice bottoming and basing occurring here. We had a pretty good Wednesday and Thursday, a little bit of retracement on Friday. I think that retracement may continue into next week, but I don't think it's serious. I think the actual evolution of this bottom and basing looks good. Into volume, we can see that in the downdraft we had an increase in volume, but right now the volume is starting to decrease, and I think that's good news. The market seems to be calming down, and I think the certainties or uncertainties are resolving themselves. Into the MAC, we see the difference between the fast line there and the slow line here. That made for some good volatility and sideways trading. There was a long way for the market to head up from here to this point, so I wouldn't be surprised if we had some more retracement into next week. I wouldn't be too concerned about it. Here in the histogram, you can definitely see nice bottoming and basing here. We're heading on our way up. We're actually into positive territory here, just barely, but that's enough for me. Into the price rate of change, again, same thing, nice bottoming and basing. It's working its way on up, so my expectations is that the market's calming down and we're starting to head back up. Their relative strength index is at a moderate 51.59, but it's positive. Into stochastics, you can see there the evolution of the bottoming and basing, as well as in the Williams. Back on up here into the price chart, another look. Now, this was the most serious downtrend that we've seen in the last 6 months or so. Looking at other charts that I'm not going to show today, but looking at other charts such as the VIX, I see that things are calming down here, and once we do base and head back up, I think we're going to be able to work higher towards the end of the year. I think that's what the probability is. However, the closer to the end of the year we get, then those politics are going to again raise their ugly head. So, at least for now, things look good. And for today, that's ChewDog Charts. Thank you.